Christian, thanks for joining us on Capital Empower. And I want to ask you right now, because AI has been front and center for a couple of years, but now there seems to be concern about AI. So tell me about AI VC, about the amplified Bloomberg AI value chain ETF, and how this can either work for me or, my favorite question is, how would it work against me? Because you always have to look at the possibilities that things don't work out.
That's exactly right, Adam, and good to see you. And yeah, the AI has been kind of in the news for the last 2 years straight, and maybe a little bit more on the negative side of late in terms of the investment perspective. There's certainly a lot of concentration when you look at AI names in the Meg 7, and many of these names are spending massive amounts of money to invest in kind of the future of AI, whether that's data centers and infrastructure. I think this year about $600 billion is geared towards spending on building out kind of what will be the future of AI. And now this kind of AI investment theme has gone from FOMO to a little bit of FUD, fear, uncertainty, and doubts on whether all this investment will really pay off. And that'll be a question that we'll find out in the next couple of years. I think there'll be winners and losers. I think one of the challenges in investing in AI is, what stocks do you buy, number one, and number two, how concentrated should you be in individual names? And if you own the S&P 500 or the NASDAQ 100, these so-called broad-based indices, they're very concentrated in the Meg 7 and thus are very concentrated in AI. And with our Bloomberg AI value chain ETF, we took a different approach. And instead of market cap weighting the AI names, we've actually equal weighted all these names so that they're the same percentage, whether or not they're a small company or a large company.
I want to interrupt you right there because I wanted to ask you specifically about what's the benefit of giving equal weight as opposed to adjusting for. NVIDIA is part of the makeup of this, I would imagine, or
right. Yes.
But so what's the benefit of giving, forgive this analogy, but NVIDIA equal weight to Fred's AI company?
Yeah, that's right. So in the last few years, the best way would have been to market cap weight because the groups that were leading the AI revolution were really the chip companies, NVIDIA. However, we've seen over the last 6 months to a year as infrastructure has been built out that we're seeing companies like networking companies, switch companies, companies that are involved in power and cooling of data centers start to actually outperform many of these companies that are maybe in the chip or hyperscaler area. So some of the hyperscalers, the Googles, the Amazons of the world, or I guess Alphabet is what we want to call them, you see that they're kind of falling off a little bit because they're investing so much CapEx into the future for kind of an uncertain return. So by equal weighting, you reduce company-specific risk that company will actually continue to be an outperformer and instead kind of equal weight or diversify that risk across the companies in the value chain of AI, because we think that it's not just chip companies that are going to lead, but there's also going to be cloud computing companies and infrastructure companies. And indeed, that's what we're seeing this year. We're seeing many of the AI infrastructure companies and chip companies start to outperform the hyperscalers, and the hyperscalers are the ones making all these investments, all these expenditures. And that's where a lot of the fear and uncertainty and doubt is coming in because they're not getting that current ROI from those spends. And there is some concern that they will going into the future. And that's hurting their cash flow currently and also making investors potentially re-rate these companies.
Well, as we talk about AI and what's going on, just AI VC in its current iteration has outperformed comparable indexes if you're going to benchmark. Can you give me some of those metrics? I look, it's early, it's mid-February. Year to date, it's up, I think, about 6%. But give me a way to put this into context, why AI VC is perhaps something that the people watching us should consider.
Yeah, so there's a variety of ETFs that you can own in this space. There's about 10 that were available in 2025, and AIVC was the second best performer, generating about a 41% return, and outperformed many kind of traditional and larger AI ETFs that have more of a market cap weighting or concentration in some of the largest names. And many of those names, again, weren't in the AI infrastructure space. In fact, some of them, the ETFs didn't even own the AI infrastructure grouping. This year, a common benchmark, whether it's the NASDAQ or the S&P, is flat to down. There's certainly a lot of concentration of hyperscalers, or so-called Mag 7 stocks in those indexes. And despite those indexes kind of being down, AIVC, as you said, has returned about 6%. So this is really what I would call a core way to invest in AI. You're not making a big bet on NVIDIA or the Mag 7 stocks. Instead, you're making an equal weight bet amongst those types of stocks, the Mag 7, but also the key networking, power and cooling, switching companies that are involved in the pick and axes, if you will, of AI. And we think that over the long term, this is a great way to have a core exposure to AI. And then for certain investors, they may want to overweight and buy some NVIDIA exposure or some Samsung exposure and maybe overweight chips. Others may be very interested in kind of networking, power and cooling, or data centers and want to own those stocks as a way to overweight. But this allows you not to be caught up in an overweighted index and have company specific risk, where if a company fails in its spending plans or a chip has issues, you don't have 8, 10, 15% of your portfolio invested in that single company. And therefore you were right being in AI, but you had an over concentration in certain companies that didn't perform, and you ended up having a not a great outcome.
Is the ETF susceptible to the whims of global sentiment? What I'm asking you, and I'll do it in simple language. China. Look, I just got back from China, had an amazing month in China, and I saw things that blew me away. And after watching the robots at the festival on video and YouTube, we have a lot of catching up to do in the United States. I personally think they're beating us actually in a lot of technology. Does that impact the ETF as people see those kinds of things, and the fact that open source AI in China really is producing product that is outperforming, it would appear, the US AI?
Yeah, it's a great point, because most US investors, if they have exposure to AI, it's domestically focused. One also unique aspect of AIVC is it's global in nature. So you do have names like Samsung, leader in chips, SK Hynix as well, a leader in chip manufacturing. So you have exposure in kind of this global aspect that the NASDAQ 100 or the S&P doesn't have when it comes to AI. And your point is correct, Adam, that there's a lot of advancements happening, particularly in China, partly because they don't have some of the rules or regulations that are popping up, oddly enough, in the individual states here in the US. So, as we're recording this today, we found out Palantir left my home state. I'm in Colorado, and they're moving to Florida. And the main reason there, even though there's a higher tax situation for Palantir, is some of the AI related regulations that the state of Colorado has imposed, and Palantir doesn't really want to be exposed to that. So in China, you don't have these province by province
government which tells you what to do.
That's right. The good and the bad, right? The big boss rules all. And here in the US, we haven't figured that out. And I do think, when you talk about risks for AI, that's a big risk that needs to be taken off the table. And that's probably having federal legislation that kind of allows AI to work in one regulatory environment here in the US instead of potentially 50. I think there's close to 10 states now that have regulations that affect how AI works and is developed within their boundaries. And it's very hard for these, startup companies to create, specialized rules of engagement in various states. So that's a risk to AI if regulation gets I'd say out of control and hinders it. The other risk I would just note, because you asked about a risk of AI VC, is we could see a return to the Meg 7 dominating. And if the Meg 7 dominates, AI VC would underperform because it's not overweighted there. You'd see the NASDAQ 100 or the S&P outperform because of their substantial weighting in those names. And how those companies could outperform is all of their investments do pay off. AI is such a game changer for all of these companies, and they win out in their investments, and the ROI starts to happen. Now, we probably won't know that for the next maybe 18 months to 24 months, but that is something to be keep an eye on. As you know, momentum in these large company stocks works until it doesn't work.
I want to start to wrap up with two final questions. First, a lot of people we've seen at the beginning of this year, people seem to be selling tech, despite the fact that $635 billion is about to be spent with AI build out and infrastructure. What do you say to people who say it's time to sell tech?
Well, I think over the long term, I think that's probably short-sighted. We've seen massive tech revolutions in the U.S. Going back and transforming the economy for more than 100 years. I know there's a lot of uncertainty and doubt about will AI produce kind of a different world, and will that be beneficial for most Americans? And I think a great analogy is to look back to the early 1900s when about 80% of Americans were involved with farming, and this was an agrarian economy, and as technology around farming, as well as food storage, frozen food, actually having ice boxes. As that evolved, we saw about, the makeup of the labor supply drop from about 80% agrarian to less than 10% now that are farmers here in the US. And that's actually been a good thing. And I think that's the promise of AI, that we could see some reinvention, some increased efficiency, and having exposure to technology is important. So I would say maybe not abandon technology, but potentially reweight technology. The other thing that I'd note is that, the last several years have been so good in the market, and what have they been powered by? These years have been powered by the Meg 7 and kind of this tech AI trade. I think there is an appetite for a rotation into some of these other industries. We see energy and basic materials being sector leaders this year, and that's been a long time since we've seen that happen. And some of these scarce resources, I think, are quite appealing as a rotation trade. They have real profits. There's been probably underinvestment in a lot of these areas, and potentially, reweighting that. We've all seen these rotations where different sectors have been leaders for multi-years, and then their sector concentration drops dramatically just because there is a market rotation. And I think, we're due for one. And I think that's why maybe some of the value sectors are outperforming the growth sectors this year. But I don't think 5 years out from now, you're going to be dissatisfied if you still have a decent weight in technology.